Welcome to the deep dive. Today, we're looking into Lyn Alden's book, Broken Money. It's quite a title. Why our financial system is failing us and how we can make it better.
Right.
And look, we know you're here because you want to get a solid understanding of complex stuff fast without, getting totally bogged down.
Absolutely. That's the goal.
So our mission today is really to pull out the key ideas from Alden's work. Why does she think the system's broken? And maybe more importantly, what does she see as potential fixes?
Exactly. And her 2023 book really goes deep. History, mechanics of money, banking. It all leads up to her, well, pretty critical take on where we are now and these alternatives she sees coming up. We'll be drawing on parts of her book for this.
Okay, great. So let's start at the beginning. What is money, really? Alden kicks off with this interesting idea, referencing Nick Szabo,
Uh-huh.
that even the earliest things that acted like money helped humans solve cooperation problems. And they actually shared traits with, well, the fiat money we use today.
Yeah, and Alden's look at those really early forms of exchange is fascinating. She talks about ledgers of account, just like basic ways people kept track of who owed what, way before coins.
Like mental scorecards, almost.
Sort of, yeah.
Yep.
Or maybe actual notches on something. Then certain items started to get used more widely.
Right. And it wasn't just anything. Alden points out things like shells, tobacco, cocoa. They became valuable, used as stores of value, ways to trade because they had specific qualities. Durable, portable.
Divisible, fungible, meaning one unit is like any other, and crucially, scarce.
Yeah, scarcity.
Yeah.
And she calls this whole package social scalability. So basically, as societies got bigger, you couldn't just rely on knowing everyone. These properties let trade and trust work on a larger scale.
Precisely. It wasn't just about the item itself being useful. It was that everyone agreed it had value and would accept it. That allowed for much more complex interactions than direct barter.
Okay, then there's the shift towards commodity money, especially metals.
Yeah.
Gold and silver really took over. Why them?
Well, Alden highlights their natural advantages. You can divide them easily. They last forever practically, easy to carry around,
And hard to fake.
and really hard to fake compared to, say, shells. These properties just made them better at holding value over long periods than the earlier stuff. She even mentions the historical gold-silver ratio, how they were valued relative to each other.
And all these things, shells, gold, whatever, they sort of different money functions, right?
Yeah.
Alden brings up a unified theory of money. What's that about?
It's about the core jobs money does. She points to three main ones: storing value, so holding wealth; being a medium of exchange, making buying and selling easy; and acting as a unit of account, a common measuring stick for value.
Right.
And different types of money throughout history have been better or worse at each of these. Gold might be a great store of value, but maybe not so convenient for everyday purchases back then.
Makes sense. Okay, so we have money evolving. How did banking come into the picture?
Alden traces it back to a really basic need: keeping stuff safe. People needed secure places for their valuables like gold. Right.
And over time, the people holding the gold realized they could lend some of it out or issue claims against it. That's the start of credit and debt.
Yeah.
Early banks were kind of like clearinghouses, just settling accounts between people.
But it became more than just safekeeping, didn't it? Alden mentions an innovation that really kicked things up a notch.
Yeah, this is interesting. Double entry bookkeeping sounds dry, I know.
A little bit.
But Alden argues it was a huge deal, a real game changer. By recording every transaction twice as a debit somewhere and a credit somewhere else, it made tracking finances way more accurate and reliable, like built-in error checking.
Okay.
Yeah.
That must have paved the way for more complex finance.
Definitely.
Now, banking itself. Alden distinguishes between narrow banking and central banking. What's the difference there?
So narrow banking is basically just that safekeeping function, pure custody, like a vault that holds your exact assets.
Got it.
Central banking is a much bigger job. It's about managing the whole country's money supply, trying to keep the financial system stable, setting interest rates, very different roles. And Alden also notes that as banking developed, settlements got faster, payments happened quicker. That seems logical, right?
Yeah.
More efficient systems.
Absolutely. Think about it, going from physically lugging gold around to just updating entries in a ledger to eventually electronic transfers. Each step dramatically speeds up how fast transactions are finalized, and that speed really helps grease the wheels of the economy.
Okay, let's zoom out a bit. Global monetary systems. Alden talks about how these big systems have risen and fallen, and war seems to be a recurring theme.
Yeah, it's a pattern she points out repeatedly. Governments needing to fund wars often resort to just creating more money.
Printing presses go brr.
Kind of, yeah. And that typically leads to inflation, sometimes hyperinflation, and the value of the currency just tanks. We've seen it again and again throughout history. It hits people's savings hard.
So that leads into things like the gold standard, and then Bretton Woods after World War II. Attempts at stability, but they didn't last. Alden mentions Triffin's dilemma here. What is that, and why did it matter?
Okay, Triffin's dilemma. It basically describes a fundamental problem when one country's currency, like the US dollar under Bretton Woods, is also the world's main reserve currency.
Right.
For the system to work, the US needed to supply enough dollars to the rest of the world for trade and reserves. But if they supplied too many, people would start worrying if those dollars were really still backed by gold, undermining confidence.
So they're damned if they do, damned if they don't.
Pretty much. You either don't supply enough dollars and stifle global trade, or you supply too many and risk confidence in the dollar itself. Eventually, the pressure becomes too much. Both the gold standard and Bretton Woods eventually buckled under versions of this stress.
Which brings us to today. The system we have now, mostly based on fiat currencies. Alden calls it a fiat ledger system. What does she mean by that specifically?
So fiat just means the money isn't backed by a physical commodity like gold. Its value comes from government say-so and, well, our collective belief in it.
Okay.
The ledger part emphasizes that most money today isn't physical cash. It's digital entries in ledgers kept by central banks and commercial banks. It's records of who owns what.
And how does this fiat money get created? It's not just the government printing presses anymore, right?
Right, that's a really key point Alden makes. Physical cash is only a small part of it. Most new money is created electronically by commercial banks when they make loans.
Fractional reserve banking.
Exactly, fractional reserve banking. Let's break it down simply. A bank takes in deposits. That's a liability for them. They owe it back.
Okay.
On the other side, they're assets. They have to keep a fraction of those deposits as reserves, often held at the central bank, but the rest, they can loan it out.
And when they make that loan,
boom, they essentially create a new deposit in the borrower's account. New money just appeared on the ledger.
wow, so it's this interplay. Central bank sets reserve rules and interest rates. Commercial banks make loans based on that. And that's how the money supply expands.
Precisely. The central bank steers the ship, influencing how much lending happens, but it's the commercial banks doing the actual expansion of the money supply through credit creation.
Alden also talks about pricing as a mechanism for organization in this fiat world. How do prices work to organize things?
Well, prices, expressed in dollars or euros or whatever, are signals. They tell everyone about supply and demand. If the price of, say, lumber goes way up, it signals there's high demand or maybe low supply. That encourages lumber mills to produce more or builders to maybe look for alternatives. It helps allocate resources, theoretically, efficiently.
But Alden also brings up the financialization of everything and the huge role debt plays now. How does that connect to the fiat system?
Her argument basically is that because creating fiat credit is relatively easy, it encourages borrowing and lending on a massive scale. This fuels financialization, where, finance itself becomes a bigger and bigger part of the economy compared to making actual stuff.
And debt is central to that.
Absolutely. Debt becomes the engine.
Yeah.
But it's also a risk, right? All that debt represents promises to pay in the future.
Which leads to another big concept Alden focuses on.
Right.
The long-term debt cycle. Why is this cycle important?
She looks at history and sees these long waves, periods where debt builds up, often fueling growth and asset bubbles. But eventually, the debt burden becomes too heavy.
And then?
Then you get a deleveraging. People and businesses try to pay down debt. Spending slows. Assets might fall in value. It can be a really painful economic adjustment. Alden suggests we need to understand where we might be in that cycle now because these aren't small bumps. They can be major disruptions.
Okay, so that sets the scene for why she thinks the current system might be broken, or at least vulnerable. And that brings us to her discussion of, well, something very different.
Yeah.
Internet native money, mainly Bitcoin.
Yes. She presents Bitcoin as a fundamentally new kind of monetary technology, born out of the internet age.
Its key feature being
Peer-to-peer electronic cash, sending value directly between two people online without needing a bank or payment processor in the middle.
And the tech enabling that is the blockchain, this decentralized distributed ledger. Can you unpack that a bit? What makes it decentralized?
Okay, so the blockchain, think of it as a shared public accounting book. Every Bitcoin transaction ever made is recorded in it. But instead of one bank holding the book, Copies of the book are held by thousands of computers, the nodes all over the world. They all work together to verify new transactions and add them to the chain.
So no single person or company controls it.
Exactly. That's the core idea of decentralization. It makes it very resistant to censorship or tampering by any single entity.
Alden also mentions the cryptography public and private keys. How does that keep things secure?
It's crucial. Your public key is like your bank account number. You can share it publicly for people to send you Bitcoin.
Okay.
Your private key is like the secret password or PIN for that account. Only you should have it. It's the mathematical proof that allows you to actually spend the Bitcoin associated with your public key. Lose your private key, you lose your Bitcoin.
Got it. Very important to keep that safe then.
Yeah.
Now, one of Bitcoin's most defining features is that fixed supply, only 21 million coins ever. Alden talks about this quite a bit regarding its potential as a store of value.
Right. This is a huge contrast to fiat currencies where central banks can and do increase the supply. Bitcoin's supply is mathematically limited, hard-coded.
So the argument is,
The argument is that this built-in scarcity makes it potentially a better long-term store of value, resistant to the kind of inflation that can erode the purchasing power of fiat money over time.
okay, but then there's the energy debate. Bitcoin mining uses a lot of electricity. Alden addresses this.
She does. She acknowledges it's a significant amount of energy. The mining process is what secures the network and verifies transactions. It's computationally intensive by design.
The proof of work.
Exactly, proof of work. She presents different views. Some argue the energy is essential for Bitcoin security and decentralization, making it worthwhile. Others raise serious environmental concerns about the carbon footprint, especially depending on the energy sources used by miners. It's a complex trade-off.
And to help with Bitcoin's speed and cost for smaller payments, there's the Lightning Network. How does that work? Is it like a separate layer?
Yeah, think of it as a layer built on top of the main Bitcoin blockchain, Layer 2. It lets users open payment channels between each other and make lots of small, fast, cheap transactions off the main chain.
Ah, okay.
Then, only when they close the channel, the net result is settled back onto the main Bitcoin blockchain. It helps Bitcoin scale for everyday use.
Makes sense. Now, Bitcoin isn't the only crypto out there. Alden touches on others.
Briefly, yes. She acknowledges the huge ecosystem of other cryptocurrencies, altcoins. Many try different things, faster speeds, more privacy, different ways to reach consensus besides proof of work. Each comes with its own set of trade-offs, strengths, and weaknesses compared to Bitcoin.
And then, still in digital money, but different. She talks about stable coins and CBDCs, central bank digital currencies. How do they fit in? Are they like Bitcoin?
Well, they're digital, yes. But Alden draws a sharp distinction. Stablecoins try to hold a stable value, usually pegged to a fiat currency like the dollar. They're typically issued by private companies and rely on reserves held by that company.
So centralized.
Very much so, usually. And CBDCs would be even more centralized. They'd be a digital version of a nation's currency, issued and fully controlled by the central bank itself.
So the complete opposite of Bitcoin's deep decentralized idea.
Exactly. Alden sees that centralization versus decentralization as the fundamental dividing line. Bitcoin aims to remove intermediaries and central control. Stablecoins, and especially CBDCs, largely reinforce it, just in a digital format.
Okay. That leads into Alden's next section, thinking about financial tech and human rights. How does she connect those?
It's a really thought-provoking part. She explores how new financial tech, especially decentralized systems like Bitcoin, could potentially increase financial inclusion.
Yeah, so.
By giving people, maybe in places with unstable currencies or poor banking access, a way to save and transact outside of traditional, sometimes restrictive systems. It could challenge existing power structures.
But digital systems also raise flags about privacy, surveillance.
Right. It's a double-edged sword, Alden discusses. Digital ledgers, like blockchains, can be very transparent. You can see transactions. But who controls the addresses might be pseudonymous.
So it's a trade-off.
It is. Different systems can be designed for more privacy or more transparency. The concern with things like CBDCs, from her perspective, is the potential for much greater surveillance and control over individual transactions by the state.
She also mentions asymmetric defense regarding censorship resistance. What's that about?
The idea there is that decentralized networks are inherently harder to shut down or censor. There's no central server to unplug, no single CEO to pressure.
Like trying to stop file sharing back in the day.
Sort of analogous, yes. It costs the defender, the network users, relatively little to maintain access, while it costs the attacker, someone trying to censor it, a lot to try and block every possible avenue. That's the asymmetry.
Interesting. So Alden wraps up by sketching out two possible futures for finance based on these technologies.
Yeah, she paints this picture of a potential fork in the road. One path leads towards a world of openness, maybe more financial freedom, innovation driven by these decentralized tools.
And the other.
A world of control, more top-down management, potentially more surveillance, perhaps using tools like CBDCs. She argues the choices we make now about adopting and regulating these technologies will really shape which direction we head in.
Okay. So wrapping this up, Lyn Alden's Broken Money really takes you on a journey from the very origins of money
Through the evolution of banking, the rise and fall of global systems.
to pinpointing what she sees as weaknesses in our current fiat system, especially around debt and these long cycles.
Right. And then presenting Bitcoin as this fundamentally different, internet native, decentralized alternative with that hard supply cap.
Absolutely. She lays out the potential vulnerabilities in the status quo quite
Right.
clearly, and then positions Bitcoin as this unique counterpoint, highlighting its potential implications for, well, the future of money itself.
And importantly, connecting it back to bigger questions about individual rights, economic freedom, and control versus openness.
Yeah, it definitely leaves you thinking. When you consider that whole sweep of history, how money has constantly changed, and now we have this digital internet native potential, what kind of fundamental shifts are we likely to see, in the next few decades? And how could that really change things for individual sovereignty and economic freedom itself?
Well, it's a lot to chew on.